All right, I am trying to get in the habit of doing a quick video recap of some of these quick value stocks. And this week, I looked at Sunrise Communications. There's my watch list. This is the Liberty Global spinoff, right? So this is the Swiss telecom company, Sunrise. I marked it as low on my interest list, and I'd be curious to hear others' take on the company. Liberty Global, on the other hand, the Remainco looks sort of interesting here, but I don't. It's sort of complicated and a lot to unpack. So let me hop over to the post as a starting point and look through that. So Sunrise, it's basically the number two player in mobile broadband TV in Switzerland. It's a three-player market for the most part. Swisscom is publicly traded in Switzerland, and they're the industry leader in that space. And that stock is actually kind of interesting if you're really into the industry or into the space. So I don't know. It's a mature market, probably slow to no growth, and Sunrise is the number two player with some debt. So the first thing jumped out to me. I just pulled up Swisscom to try and get a feel for what the industry looks like or what the main player is doing, right? And this is a 20 plus year chart of operating cash flow and free cash flow. So first thing jumped out to me, operating cash flow is flat for like 20 years, right? And free cash flow is down. It's down, although it's flat for the last 10, maybe up. Maybe you consider that up for the last 3 or 4 years compared to the last 10 years. So it's a capital intensive and slow to no growth industry, and CapEx is driving probably the bulk of the cash availability for distribution or use in anything else, because operating cash flow isn't really going anywhere. So that was the first thing that jumped out to me in looking at this. So kind of makes me feel meh about the stock to begin with. They gave us a picture of 3-year financials for Sunrise. No revenue growth. EBITDA is flat, right? They give us this basically an EBITDA minus CapEx type number. That's up a little bit. So we have that as a reference point as well. And then they give us an outlook. So we got 24, 25, and then midterm targets, right? Stable revenue, stable to low single digits. So to me, that sounds like 0 to 2% type growth. I don't know. It doesn't even look like Swisscom is getting that. So that's the first comment on the outlook. They're targeting this dividend and paying down some debt. And it looks like all of that free cash flow, where's their slide deck? All of that free cash flow that they're anticipating, where's the chart? So this is what they're hoping for, right? Here's the leverage. Liberty kicked in some cash. Leverage comes down. Maybe it'll come down a little bit through the end of the year. And so once they hit that leverage target, then they want to turn on a dividend of 240 million Swiss francs. And here we go. So most of the free cash growth is coming from this lower CapEx requirement, right? 16 to 18% down to 15%. And yeah, that will fuel this growth in free cash from 360 to 400 plus over the midterm, right? Over that time frame. So all of your free cash flow growth looks like it's coming from CapEx and not from actual fundamentals like revenue or EBITDA. So I don't know how I feel about that. But anyway, they're taking that free cash, and what do we say the market cap was? So call it 360 million free cash flow. Market cap is 3.7 billion. So you're looking at right around 10x free cash. I have leverage at 4.85x based on this 1030 or 1.03 billion EBITDA number and net debt of 5 billion. So 4.85x leverage, trades at 8.4x EBITDA, 10x free cash flow. Those are kind of the starting point valuation metrics. And part of that will depend on how you treat the 96 million shares outstanding. They have an A class and a B class. B class has super voting rights, but they're entitled to 1/10 the economic value. So yeah, it's up to you if you want to say all of those shares are not worth the current stock price of $43, $45 a share. The dividend math is sort of where it gets interesting, right? If they're targeting this 2025 dividend of 240 million and the B shares aren't entitled to a dividend, then, or if they're only entitled to 1/10, then you could be looking at $3.70 a share US of dividends on a $43 to $45 stock. So what is that? At $45, it's an 8% plus yield. So this is a super levered, right? I think it's super levered. It's pretty levered. Once they turn this dividend on, they're only going to have like $100 million of free cash available to do anything else with. So there's not going to be any meaningful deleveraging going on from here on out, I don't think. So you're looking at this levered high dividend yield, capital intensive, low, no growth business in a developed market. So I don't know, maybe that's interesting to some people. I'd love to hear your thoughts on it. Swisscom, as a reference, trades at 7.5 times EBITDA, 15 times free cash, basic, not unlevered, but really low leverage, and has gotten lower. And the dividend yields, call it 4.4%. So yeah, I don't know. I don't know if that's the right comp for this business. It's just very different looking. So that's Sunrise. The flip side to that is the valuation that Sunrise came out, right? Call it 8x EBITDA or better, and a whole bunch of debt, right? That comes off of Liberty Global's books. So now Liberty Global, they lose Sunrise. They're left with these 3 other wholly owned assets, these 2 50% JVs, and a whole host of other investments. So that's what Liberty Global is now, right? 3 opcos, some JVs, and a portfolio of other stuff, and a bunch of debt. Kind of sounds like B. Riley. Okay, so that's Liberty Global Remainco, right? And here's the segment financials from Liberty Global. And you can see the EBITDA numbers, right? 23, 22, 21. Sunrise was a big piece of the Remainco valuation, and now that's gone, right? Now that's gone. So now Telenet, the Belgium subsidiary, that is going to be the biggest piece of OpCo value, right? Or Remainco EBITDA, whatever you want to call it. And then these JV interests are obviously very, very valuable. They're very large, but it depends on how you want to treat that from a valuation standpoint. And they have their own separate non-consolidated balance sheets. So kind of an interesting but messy makeup, right? I've got 357 million shares, $13. That's a $4.7 billion market cap or so. Pro forma for the divestiture or for the Sunrise spin, net debt looks like 8.6-ish in net debt. So I got an EV of $13 billion, and here's your EBITDA for Remainco. Call it 2.4 billion minus this 1.1 for Sunrise, and you're looking at like 1.2 billion of OpCo EBITDA. So I'm ignoring the investments. The investment portfolio has all this stuff in it, right? This is everything that's in there, including the JV interests, which make up the lion's share of it. Now, these are equity method investments, so earnings would add to it, losses would decrease the balance. They're not tied to fair market value at all, right? So take that for what it's worth, and then everything down here is in that fair value bucket. Some of these things are listed, right? Like here's Lionsgate, it's a listed stock. And some of them are not listed. So, yeah, that's that. But you got $14 billion here of stuff. Where's this? Here's the December. This is December 2023. You got almost $14 billion worth of stuff. Now this number's changed since September or to September. $14 billion worth of stuff. And that's the lion's share of the valuation here, because the OpCo EBITDA, 1.2 billion. I mean, that's pretty small, especially when you got $8.5 billion of debt. So it's almost like a levered investment portfolio and a leveraged set of operating businesses, which is very much like what B. Riley was trying to do. The difference is they're trying to sell some of this stuff off, monetize it, do some other things, and that may or may not work. Where do I want to go from here? Yes. And Liberty's been a huge buyback machine for years, and I don't really think that that's worked, right? Here's the stock max chart, right? And I know they've spun and sold some stuff, but still, I'd say that the buybacks have not been effective in moving the share price to date. So now they unloaded Sunrise. They're talking about monetizing and unloading some other stuff. And here's what you're left with. This is the free cash flow picture for 2024. Sunrise is now gone. Telenet is down, but they're going through a CapEx period, right? This other OpCo business unit is generating losses or cash outflows. And then you've got your JV interests, and these are the distributions they expect from those divisions. And this is a big number, right? With the currency conversion for these two, that's like $1.3 billion on a $4.5 billion company. But I don't know if these are sustainable numbers. Clearly not what they've generated in previous years. So I think valuing that investment portfolio is a big component and probably pretty challenging, right? So what do you got that marked at? You got Virgin Media marked at $7 billion, and the Netherlands JV marked at $2 billion. And those again are equity methods, so like a carrying value, not a fair value. So when I did my write-up, I just said, okay, $14.5 billion is $40 a share, just undiscounted. That's the balance sheet number, right? Straight out of the balance sheet, divided by share count, $40. And I said, okay, well, if that leaves net debt of $8.5 billion, that's probably what the operating businesses are worth. Let's call it 7x EBITDA, right? So that, what does that mean? That there's $40 of upside if they could get full value for the investment portfolio? I don't know. I don't know that that's the right way to look at it, but it certainly could mean there's some value discrepancy here and something worth digging into. So I haven't dug deep enough to know what their plans are for future spins, future asset sales, or future buyback capacity or pace, right? What are they looking to do? But it seems like there's an interesting jumping off point. I would probably prefer to see them whittle down the investment portfolio. And frankly, for this type of business, a dividend policy would have maybe been more fruitful over the last several years than the buyback approach. So I did some basic math and said, okay, let's just say the debt covers the OpCo EBITDA, 7x EBITDA, right? And then a 25% discount to the investment portfolio gets you $10.9 billion. That works out to $30 a share, and the stock's at 13. So I'm not implying that's what it's worth, but to me, maybe that means it's a good enough starting point to take a closer look. Would love to hear some thoughts. Let me know what you think about either of these pieces.